Hello, and also hello. Today, we're going to talk about the type of subscribers on this channel. Firstly, the bulls. Glass half full types who generally remain optimistic about life, the markets, drown out the noise, and buy the dip. Secondly, the broke bipolar bears. Half empty types who are margin called every other week and prefer to see their investing account go lower because it means they have to pay less alimony.
No more alimony.
They also know all the names to the recession indicators. Number 3, the chart pattern guys. These kids have attention deficit hyperactivity disorder and are allergic to income statements. The macro bros who called 50 of the last 3 recessions. The middle class dads who buy the dip only in ETFs, outperform everybody, and listens to Tom Lee.
Well, it's been a rough week. I mean, this September first 4 days were down 4%. It's actually one of the 5th worst September since 1928, so it's pretty bad. I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward to seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks jumped Monday after investors bought the dip following the worst week so far in 2024 just last week. We saw everything really rally except for Google, which was down 1.93%. That was on the back of some of the antitrust issues it's having. Google is officially below 150. Apple was largely flat, down 0.1% after the iPhone 16 event. There was nothing really to see there. Apple Intelligence underwhelmed. Gone are the days where Apple events produced something great and innovative. It's now just a rerun of the exact same thing every single year. But semis strong rally led by Nvidia as well as AVGO. Microsoft partook as well. Same with infrastructure. Oracle sold off into its earnings today, but is actually up about 8% in the after hours after it double beat and raised. Very strong move right there. And I think that's going to benefit stuff like Google, Amazon, Microsoft as well, especially in the cloud and software space. Software, very green today. So too was financials, guys. Everything was really green. There wasn't really much to say. Investors just really bought the dip across all sectors: tech, industrials, discretionary, financials, real estate, utilities, materials. They were all up 1% here today, and even the worst performing sectors, stuff like staples, healthcare, energy, com services, down 0.4% respectively. So a very, very upbeat day. We even saw small caps rally, mid caps rally, but it really was a day for large growth, large size among everything. That was really the icing on top of the cake. And the trade today was very, very simple. You see, there's still a lot of election uncertainty, macro uncertainty right now. And when the market is going to bounce, we did get very oversold last week. And when the market does bounce, you're going to buy quality stuff like the S&P 500, the Nasdaq 100, the equal weight over small caps. But that's not to say small caps were sold off in relation to the larger caps. It's just that people put more money into larger caps. A lot of the money that was on the sidelines went into the Nasdaq 100, the S&P 500, and really just US stocks as a whole. We saw US stocks outperform. North America was very, very green. Same here with Europe, but the same could not be said for Asia stocks. China was very, very red. Same with the southern eastern part of China here, the semiconductor belt, as well as Australia. Very red across the board right there. So very mixed day across the global markets, however, which does tell us that there is a bit of uncertainty under the hood. But let's dive into the S&P 500. And today's trade was simply underpinned by cash on the sidelines going into stocks because we saw some very obvious developments that in any normal trading day would actually hurt stocks. For example, the dollar was up 0.5 percentage point today. Normally when the dollar's up that much, it really weighs on the mega caps, but stuff like the Nasdaq 100 was up 1.3% today. So today was really just cash on the sidelines going into the market. We did see yields in the longer end fall, but gain here in the 2-year. So the short end of the curve did gain, and that's probably why we saw mild underperformance in the IWM relatively speaking. However, all of these indices are very upbeat here in the after hours, especially the Qs up 0.22%. Same with the SPY, the IWM as well. Volatility got crushed officially below the 20 handle, and then gold and silver were up 0.4 and 1.53% respectively, and then crude seeing another huge bounce up 1.4% as well. So very interesting trade there in the commodity space. And looking at the S&P 500, some very interesting developments here on the gamma chart. Number one, we actually saw the gamma flip zone move from the 5500 to the 5470. For those of you that don't know, the gamma flip is how we know which way to trade. Above it, you're long, below it, you're short, aiming for these targets right here. This is based on the options market and dealer hedging as well as gamma flows. But it's really simple to just say long above, short below. You're actually buying dips, selling rips, because that's how dealers hedge their portfolios. In a positive gamma environment, you want to trade with big money. The dealers, they make up about 40% of market volume. And then below the gamma flip zone, dealers actually sell into weakness, buy into strength. And that's why you see these large high volume moves that can turn and reverse very, very quickly. And that is why tops tend to be a process, as you can see right here, and bottoms tend to be an event that can happen in 1 or 2 candles. Nonetheless, we did see the gamma flip zone move from 5500 to 5470, and the put support also moved down from 5400 to 5350. However, we are right here, you can see, on the cusp of being between negative gamma, positive gamma, and that tells us a couple of things. If tomorrow the rally continues, which it is here in the after hours, we are going to actually be in positive gamma, and in that case we buy dips, sell rips, and we could actually just get like upward momentum into the CPI reports later this week, and then the macro could cause volatility one way or the other. But if we do see some weakness, let's say we gap down, open below the gamma flip zone, then that means the 5350 becomes our next target, and then the level that becomes critical is simply Friday's low. And if we were to, let's say, break below this level right here and then move, find support, and then break this level, let's say into Tuesday, Wednesday, Thursday, then 5350 does become a possibility. So if we do open in positive gamma tomorrow, guys, what you want to look at is this level right here. Do we hold that level into the close, or do we break it? Do we wick below it? Any movement above it is constructive. Any movement below it probably means we do go see these lower levels. That being said, if we continue to stay in this positive gamma environment, which we are right now in the after hours, 5600 is our obvious target, but we do want to start taking some of these levels right here, the 5520 and the 5550 level first, before we actually look at the 5600 area. We are still in a daily downtrend, however, so be careful, guys. This could just be a one-day bounce. Yes, things are looking positive in the after hours, but this is all-time highs. We've made a lower high. We are in a daily downtrend, and some of these candles are looking ugly in the context of weaker macro and earnings that didn't live up to our expectations. So do keep cash handy. A lot of the volatility that we do get in September is actually back-end loaded. Maybe we did front load a lot of September seasonality, but we are still in the most volatile month of the year, and you should expect nothing less. Looking at some other indices, the Nasdaq 100, the gamma flip moved down to the 19,100 level and in a very, very clear downtrend. But it seems like the market is trying to hold this level right here. And as long as we stay above this low, I think that is constructive for us to go ahead and retake all-time highs. Looking at the IWM in the form of the RTY, very similar situation. The gamma flip did move from 2150 to 2125. We actually did see a little bit of selling here at the gamma flip zone, which is not constructive. Nonetheless, a green candle still up for the day. The futures is up 0.7% here from these lows. And I do think, again, very similar to the Nasdaq, as long as we hold this level right here into September, I think we're looking very, very constructive to go ahead and hit these new 52-week highs. But firstly, these highs need to be taken out here, this 2220 level. So things looking very flip-floppy here in the Russell 2000, things looking kind of constructive in the S&P 500 as well as the Nasdaq 100. The best performing chart, the best looking chart is still the RSP. We can actually see that this was a line we were looking at because we used it as resistance right here, and then it's actually where we broke up to the upside to go ahead and make new all-time highs. We did actually go ahead and break that on Friday, but we have since retaken it here on Monday. Very constructive, and I would still look at this as a key line in the sand, and I would still look for outperformance to come from the broader market, the equal weight versus the market cap weight and the Nasdaq 100. I do think that this is still going to have relative strength to the upside into the end of the year, especially as earnings do broaden out. But all in all, guys, I think what you want to watch tomorrow. Number one, the dollar. Okay, that's a key thing you want to watch. The macro, you definitely want to look at the macro, but how does the macro affect yields? Right now, if we get softer macro, that means yields are going to fall. And if we get better than expected macro, that means yields are going to rise. If we get better than expected macro, let's say the CPI report, and yields actually fall on the back of that, that is game, set, and match. And that is the point when you want to actually start looking at smaller cap names, because then you have stronger macro, weaker yields. The market at that point is telling you the Fed is cutting to normalize policy. Growth is looking good, whereas right now the market is sort of grappling with the fact the Fed is cutting rates to spur on economic growth. But if we continue to do what we've been doing in the last couple of weeks, where weaker macro has led to softer yields, stronger macro has led to higher yields, you should continue to expect digestion, especially in the bigger names, especially here in the month of September. And you just want to keep following the plan. Above positive gamma, you want to buy dips, sell rips. Below negative gamma, you want to sit through the volatility and buy names, stocks, and ETFs that you like at very, very key levels. I have a general rule of thumb. You want to load the boat every 5, 10, and 15% drops in any stocks that you like. You sort of do a big buy every 10%, a little buy, as well as your constant dollar cost average plan every single week. This way, you're sort of just ignoring the noise and taking advantage of stocks when they're on a discount, because normally, 10% pullbacks are actually quite rare. It only happens about 2 times every single year. So to get these pullbacks right here, it's actually a bit of a gift, because the recovery tends to be short and sharp, and oftentimes you won't get that dip again in that year. And look, we could just rally from here. That's why you always want to take advantage when we do get these dips. That being said, continue to expect market volatility in September and through October. But as it is in the here and now, guys, we are in positive gamma ever so slightly. So buy dips, sell rips to the 5600 area. Looking at sentiment, this is the weekend poll, guys, something we do every single week. And today I posed a question: what index are you most bearish on this week? 61% of you said the Nasdaq 100, 15% of you are least bearish on the Russell 2000, and then the S&P 500. So pretty much mega caps, large caps, small caps. What are you most bearish on? And yeah, sentiment not looking good for large caps. And look, if we see the Nasdaq 100 outperform this week, I would not be surprised. These sentiment polls are ripe to be faded. Guys, we're going to take a look at Q2 earnings, because we're pretty much done earnings season. 498 companies have reported in the S&P 500, and things are looking rather good. Now, not much has changed from last week. These are the figures officially. S&P 500 earnings at 13%. Revenue at 5.5% growth, margins at 12.3%. They actually did tick up 10 basis points from last week. Very robust margin growth, and these smashed the earnings expectations of analysts at the start of earnings season, particularly margins. Margins was the big story right here. So despite all of the volatility we've seen in the market, the fundamental picture remains intact, with 79.1% of companies reporting above analyst expectations. And the fact that we've had this volatility in light of amazing earnings goes to show the expectations in these earnings. And this also gives us an indication that maybe the trade into earnings season was a bit crowded, especially in these tech names. Nonetheless, Q3 earnings may be a little bit softer. We have seen quite significant down revisions in every single sector except for info tech for the third quarter, leading S&P 500 downward revisions for the third quarter, negative 2.8%. While not crazy, the market does have to price this in, and this is also part of the reason why we're seeing volatility in the market. We're having revisions come down, and normally price follows earnings. And this graph doesn't tell the full depiction of what we're actually seeing in earnings right now. Earnings growth is spreading beyond the big superstars. We are seeing a broadening out in earnings. In other words, the top 5 stocks, their earnings are decelerating, and we are seeing accelerating earnings in the rest of the index, the broader market. And this is why in this dip, it's definitely best to add exposure to mid caps, small caps, the broader market, and stuff outside tech. However, you still do want exposure to technology, because they're still growing at a high higher clip than the rest of the market right here. This is just a deceleration in earnings. Tech next year is still looking to grow earnings at about the 20% mark, which is above the rest of the index. Very bullish, and that is why you definitely do want exposure to tech. But looking at the market overall, the pullback we've seen in the last couple of weeks has actually brought the market back to its fair value. You can see that we were undervalued here in the August sell-off. We were then in overvalued territory, and we've now come back to fair value at the zero line. And the further we pull back into the undervalued zone, the bigger the rip to the upside will be. And looking at a presidential election year analog, that rip to the upside could be huge. This is S&P 500, what we've done in 2024, this black line, and this blue line is a presidential election year overlay. It does indicate that there's probably more downside left, but then when we do form this bottom and rally up into the end of the year, have the election come to pass, we normally see outsized returns in the rest of the year, and that is why you do want to buy the dip. But going back to valuation, while the market appears to be fairly valued, not all segments are made equal. The large cap space, core and growth are actually kind of overvalued, especially the core segment. Value is, I would say, at fair value, and then the rest of the market apart from mid cap growth is relatively undervalued. So you can see that the large cap segment is overvalued, mid cap growth overvalued as well, and the broader market, the rest of the market, mid caps and small caps, are actually materially undervalued. And these are the places you want to add exposure in your portfolio, particularly going into a cutting cycle. But it's also good to look at stuff like large cap value. There are a lot of dividend stocks in there, as well as growth. Despite the valuations you see in large cap growth, it still is largely attractive, because even though you are paying up for growth, you're also paying for extremely high quality businesses. The large cap growth segment has some of the best businesses in the world, especially in the US, and you definitely do want exposure to those comm services companies, those tech companies, those discretionary companies, those financial companies in this segment. And diving into some macro, this is GDP forecasts for 2024-25, the consensus, as well as Goldman Sachs forecasts. Very interesting developments we see here. Now, second quarter GDP is sitting at 3%. We have those figures already. And Goldman see third quarter, fourth quarter GDP at 2.5, 2.4% respectively. Analysts don't think so. They see GDP coming in at about 1.6, 1.7% in the third quarter, and then below the 1.5% mark at 1.4% in the fourth quarter. But then they do see more upbeat expectations into 2025. But Goldman still project GDP above the consensus expectations. And again, guys, the truth is probably somewhere in the middle. If we get a flat 2% figure from the third, fourth quarter into 2025, I wouldn't be surprised. But GDP is one part of the equation. The other part is the employment market. And just giving you a quick update on non-farms. Non-farms came in quite weak. The unemployment rate at 4.2%. This was the consensus expectations. This is what we got right here at 142,000. And the labor market definitely softening, but not necessarily tax receipts. August tax receipts is officially in the books at 6.5% growth year over year, and September right now tracking at 5.2%. Absolutely insane. The only negative comp we had was December 2023. And so this is a clear divergence between non-farms and tax receipts, and it could signal a number of things. It could mean increased productivity, increased taxation, stronger corporate profits or capital gains, or simply just higher wages and increased income. Nonetheless, tax receipts are strong, and that does bode well for the economy in aggregate. And if we do see a rebound in the employment numbers at the back end of the year, and we continue to see strong tax receipts, that could mean a lot of money into the system, which then just gets recycled into the economy. We'll see how this plays out. Diving into PMIs, something we didn't cover a lot last week, so I thought we'd just cover it in today's video since we have everything in aggregate. And this is my top 5 takeaways from the global manufacturing PMIs. Number 1, global factory output fell in August, the first monthly decline since last December, making a contrast to robust gains over the second quarter. Manufacturing exports dropped for the third month running, weighing on the overall sales environment for producers and contributing to to the fall in output, demand was hit by renewed destocking as input purchases decreased in a bid from manufacturers to save costs. This was global input buying and supply delays. And then looking at PMI future output expectations, confidence levels remained weak compared to long-run trends, with producers reporting concerns about geopolitical uncertainty, rising protectionism, and falling trade in particular. And lastly, manufacturing prices rose at a softer pace as wage pressures eased despite further pressures in logistics costs due to a recent spike in shipping prices. Data tomorrow, we just have NFIB Business Optimism Index. Then Wednesday is when things really get going with the CPI numbers, headline and core figures. Other than that, we really don't have anything else. We just have a very light week of earnings, with Adobe being the biggest earner this week here on Thursday.